Does a business that brings in $300,000 a year but struggles to set aside even $15,000 really have a solid financial foundation? And what happens if an unexpected $30,000 expense shows up tomorrow? In this video, you'll learn the 7-7-7 Business Finance Rule, a simple framework that reveals how financially strong your business really is. The first rule is maintaining an interest coverage ratio of at least 7. Let's start with the basics. Anytime a business borrows money, it commits to making interest payments. Those payments don't disappear when sales slow down. Whether business is booming or the economy softens, your lender still expects to be paid. So the real question isn't, can I make this year's interest payment? It's, how easily can I make it without putting my business under pressure? That's exactly what the interest coverage ratio measures. The formula is straightforward. EBIT divided by interest expense. EBIT stands for earnings before interest and taxes. Put simply, it's the profit your business generates from normal operations before interest and taxes are deducted. Let's look at a simple example. Suppose your business generates $700,000 in EBIT each year while paying $100,000 in annual interest. Divide $700,000 by $100,000 and your interest coverage ratio is 7. In other words, your operating profit covers your interest expense 7 times over. Why is 7 such an important benchmark? If your ratio is only 2 or 3, your business has very little margin for error. A temporary drop in sales, higher operating costs, supply chain disruptions, or an economic slowdown can quickly create financial pressure. But when your coverage reaches 7 times or more, you have a meaningful safety cushion. Even if profits fall by 30% or 40%, your business can still comfortably meet its interest obligations. Lenders view that as financial strength. Investors see it as disciplined financial management. If you're just getting started, here's a simple exercise. Calculate your annual EBIT, then divide it by your total yearly interest expense. If the result is below 4, your debt load may be creating unnecessary risk. If it's 7 or higher, your business is operating from a much stronger financial position. This single metric helps protect your company during difficult economic periods because it encourages responsible borrowing and long-term financial stability. Debt itself isn't the problem. Weak cash generation is what turns debt into a risk. When your interest coverage is strong, you stay in control of your financing instead of letting your financing control you. You have greater flexibility to refinance when interest rates improve, negotiate better loan terms, and invest in future growth with confidence. But when your coverage is thin, every slow month becomes a source of stress. A 7 times coverage ratio doesn't just strengthen your balance sheet. It also gives you confidence, credibility, and the flexibility to make smarter decisions in an unpredictable economy. The second rule is maintaining a levered free cash flow margin of at least 7%. This is one of the biggest concepts many new business owners misunderstand. Profit and cash are not the same thing. A company can report impressive net income while still struggling to pay payroll, suppliers, or monthly bills. Why? Because accounting profit includes non-cash expenses and timing differences that don't reflect how much money is actually sitting in your bank account. What truly matters is how much cash your business keeps after every major obligation has been paid. That's where levered free cash flow comes in. Levered free cash flow is the cash your business has left after covering operating expenses, taxes, capital investments, and required debt payments. It's the money that's genuinely available to reinvest, build reserves, reward owners, or pursue new opportunities. Now let's look at the 7% benchmark. The formula is levered free cash flow divided by total revenue. Imagine your company generates $5 million in annual revenue and produces $400,000 in free cash flow after covering all debt obligations. Divide $400,000 by $5 million and your free cash flow margin is 8%. That means every dollar of revenue leaves your business with 8 cents of real spendable cash. Why is a 7% margin so valuable? If your free cash flow margin is only 3% or 4%, your business is operating with very little financial flexibility. A single unexpected expense can quickly eliminate your cash cushion. Rapid growth can even become risky because expanding operations often require even more cash. But when your margin reaches 7% or higher, your business consistently generates healthy internal cash flow. That means you can reinvest without constantly relying on loans. You can build emergency reserves, weather economic downturns, and negotiate from a position of strength. If you're evaluating your own business, don't stop at net profit. Calculate how much cash actually remains after operating costs, taxes, loan payments, and necessary reinvestment. Then divide that number by your total revenue. If your free cash flow margin consistently stays above 7%, you're running a cash-strong business. If it doesn't, it's time to improve your pricing, increase operating efficiency, or reduce unnecessary costs. Cash creates freedom. Accounting profit is simply a financial measurement. Revenue growth without strong cash management can quietly weaken a business because sales alone don't guarantee financial health. A free cash flow margin above 7% shows your company is generating enough internal cash to support its own future rather than depending entirely on banks or outside investors. It gives you greater resilience during slow periods and more confidence when it's time to grow. When your business still has real cash left after every major obligation has been paid, you're no longer relying on optimism. You're operating from a position of financial strength. Healthy cash flow gives you the freedom to seize opportunities as they arise while making unexpected challenges much easier to handle. The third and final rule is keeping your cash conversion cycle under 7 months. Let's break this down in a way that's easy to understand. Your business doesn't just generate revenue, it moves cash through a continuous cycle. First, you purchase inventory or invest in delivering your services. Then you make the sale. Finally, you collect payment from your customers. The amount of time between spending your cash and getting that cash back is called the cash conversion cycle, often referred to as the CCC. The calculation is simple. Inventory days plus accounts receivable days minus accounts payable days. Inventory days measures how long your inventory sits before it's sold. Accounts receivable days measures how long customers take to pay you. Accounts payable days measures how long you take to pay your suppliers. Your total cash conversion cycle should stay below 7 months. Why does that matter? Because when your money sits tied up in inventory or unpaid customer invoices for too long, your business eventually runs short on cash, even if sales continue to grow. Let's look at a simple example. Suppose your inventory sits for 3 months before it's sold. Your customers take 4 months to pay their invoices. Meanwhile, you pay your suppliers within 1 month. 3 months plus 4 months minus 1 month gives you a cash conversion cycle of 6 months. That means every dollar you spend takes 6 months to return to your business. If that cycle stretches beyond 7 months, growth becomes much more difficult to finance. You may find yourself relying on loans or lines of credit simply to cover normal day-to-day operations. But when you consistently keep your cash conversion cycle below 7 months, money flows through the business much faster. You need less borrowed capital, expansion becomes easier to fund, and your overall financial risk declines. If you're a business owner, here's a practical next step. Measure how long your inventory remains unsold. Monitor how quickly customers pay their invoices. Work to negotiate longer payment terms with suppliers whenever possible, and eliminate inventory that sits on the shelf for too long. Shortening your cash conversion cycle improves liquidity without requiring a single additional sale. This rule reinforces one of the most important habits in business finance: operational discipline. Strong companies don't succeed simply because they generate profits. They succeed because they move cash efficiently, protect working capital, and maintain control of their financial operations. If you found this video valuable, be sure to like, subscribe, and share it with another business owner who could benefit from it. Thanks for watching, and I'll see you in the next video.